Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 120 for 2020 tax planning tips. Wow, that was a lot to say in the intro. Tax planning tips. Anyways, I hope all of you out there are staying safe and healthy. Welcome to another episode of Upticks, where this week I want to take you through some tax planning strategies to consider before December 31 of 2020. Now, let me guess, like most of you out there, like my accountant hasn't reached out to me to talk about tax planning. And in my experience, a lot of them don't do that. I feel like a lot of accountants are always, this is what happened, instead of this is what you need to do to make what happens better. So, as an offering at Falcon Wealth Advisors, why we certainly are not CPAs, we do not give tax advice. We do, however, do tax planning. And we'll flash up on the screen here. I've got a gentleman on my team named Matthew Johnson, who is a certified tax specialist. Basically, that's an accreditation that he studied for and received that allows him to do some tax planning on our team. We also want to flash up on the screen. I have two certified financial planners in James Lewis and Matthew Tomlin, who have taken and passed the curriculum to help with some more advanced planning strategies. And as part of that test or accreditation is a tax section. So again, they're not CPAs, they're not accountants. They're not looking to file your taxes or do anything like that, but we can do some tax planning that you could turn around and take to your CPA and say, hey, this is what my financial advisor is suggesting I take a look at or do. Can you give me some tax advice and tell me how will this impact my taxes for 2020? And it's not too late, right? So again, we've got about a month left here before the end of the year. So we want to make sure we're doing some tax planning. So for today, I wanted to give you 4 topics, and I'll start with number 1. And number 1 is simply make sure that you have adequately contributed to all of your tax deferred accounts. Now, what in the world am I talking about? Well, easily, if you're still working, I'm talking about your 401k. And if you're under the age of 50, you can contribute up to $19,500 a year of your money. This does not include your employer match. This would be your money into a 401k plan. Or if you're over the age of 50, it's $26,000. Okay. So you want to make sure, and again, I'm not necessarily saying you max that out. I'm just saying that if you do want to max it out, that you are, or that you've put an adequate amount in there. I also want to make sure that if you are putting at least the amount to get the company match, because that's technically free money. You also want to check any health savings accounts. Those can potentially be triple tax exempt. So not only do you get a deduction when you put money in there, the money can potentially grow tax-free as long as when you do pull it out, the third step, used for qualified medical reasons. So 401ks, health savings accounts are very important. Donor advised funds are another one. Falcon Wealth Advisors, we do a lot of work with donor advised funds. So if you have appreciated stock or just cash that you want to put into a donor advised fund, what this is a vehicle that you put money, it's an account, you put money in, you potentially get to deduct that from your taxes, and then you can dish it out to charities over several years. You don't have to give it all away that year. So you may put $50,000 in this donor advised fund and only give $5,000 away a year, right? But you could potentially take most all of that deduction in 2020. All right, so number 1 is just check those tax deferred accounts, 401ks, health savings accounts, donor advised funds, accounts that you may already have established or that it's easy for your advisor to establish for you, so that you can put some money in there, get some tax deductions, and lower that 2020 taxable income. All right. One tip I do want to put as part of this first one is that don't wait until December 31st to do this, though. The banking world, it takes time. It takes time to open an account, right? It'll take a day, 2, 3 days to get all the paperwork filed and everything established. Then if you're going to write a check or defer money from your bank, that can take a few days to clear. So don't wait to the last minute. Do it early December, or mid-December, probably at the latest. you don't want to be calling your advisor on December 31st saying, hey, I'd like to open up a health savings account, or I want to open up a donor advice fund. What do I need to do? Because it's probably not going to be able to happen. Not because the advisor is not good. It's that it takes time. You got to file paperwork. It's got to get approved. It's got to get processed. So give yourself some time, do some tax planning early in the month of December to make sure that you're doing everything that you can. Okay, very good. So number two would be to check your realized and unrealized gain loss report. Now, we use a custodian called Charles Schwab. It's very easy for us to pull this up for our clients. And if you have a taxable account, so this does not include IRAs or Roth IRAs, we're not worried about unrealized or realized gains or losses in those accounts because that is deferred, or in Roth IRAs, since this is tax-free. But what I am talking about is if you do have a trust or an after-tax account and you have realized or unrealized gains or losses, we may be able to buy or sell certain stocks or bonds in your account to either offset that, right? So if you have a big gain and you've got some losses and some other things, we may be able to lower that. Or some people, that's called tax loss harvesting. Some people like to do what's called tax gain harvesting. So if you're worried about taxes going up and you've got a gain that you want to realize this year, because we know what the long-term and short-term capital gains rates are, and you want to protect some of that, you can realize it this year with the expectation that, hey, in 2021, I don't know, the taxes might go up. There's a new administration coming in. Who knows? Nobody knows for sure right now. But that may be something that you definitely take a look at in there. So if you don't know that, it's an easy call for Falcon Wealth Advisors. Give us a call, send me an email. We'll set up a time to talk, a 15, 30-minute discussion. We could take look at your realized, unrealized gain or losses and see if there's anything we want to offset by lowering it, or maybe some things we want to do ahead of it and realize some gains in 2020 because we think the taxes may go up. Again, nobody knows that though. All right, so that's tip number 2. All right, for tip number 3 in here, if you're in your 70s and you have an IRA. So normally, or it used to be, if you're 70 and a half, which again has all been waived for 2020, but if you're 70 and a half, you would have had to take what's called a required minimum distribution from any IRAs. Now, for 2020, like I said, that's waived. And actually, they've increased the age for future years to 72 years old. So, you know, if you're 72, starting in 2021, you're probably going to have to take a required minimum distribution. Now, but one thing you can do for 2020 is do something called a qualified charitable donation. And what this is you can take money out of an IRA if you're over 70 and a half and donate that directly to a charity and not pay any taxes on that distribution. All right, now there's certain limits and thresholds. And again, you want to talk to us before you do this. But the reason you would do it this year is that you would lower than that IRA so that next year, your required minimum distribution is maybe a little bit lower. So you said, hey, I want to give some money to a charity. I was going to do it in January. Why don't you go ahead and do it in December, lower that IRA account value so that next year you don't have to take out as much from your IRA. So again, this would just be paying forward your charitable donations a little bit earlier, right? Which could potentially help you next year when you perhaps will have to do a required minimum distribution. All right, good. And then the fourth tip I have for you is to reach out to your financial advisor. Again, a lot of CPAs, and again, nothing to discredit them. I think they're a great profession. They do a lot of great work for people. But in my experience, a lot of them are just looking at the past. They're going to, you're going to reach out to them in February or March when you get all your 1099s and W-2s and you say, okay, here's what I did. And they're going to say, okay, this is what you owe. But I don't see it very often happening saying, oh, I should have, they're never going to take the blame. I should have called you in December. You could have done this. Well, what we're saying at Falcon Wealth Advisors is we will do that. So if you do, and again, we're not tax advisors. I want to be very clear on that, and disclosures is that we do tax planning though. So if you say, hey, if you're concerned about what your taxes are going to look like, give us a call, client or no client. If you're not a client, what we'd like to do is take you through our planning process, create a financial plan, take a look at all of your investments, and then we can do some tax planning for you. Maybe you want to look at converting an IRA to a Roth IRA this year, or maybe you want to look at your charitable donations, and we're going to make sure you're maxing out your tax deferred accounts, right? We can do all that stuff for you to set you up to have potentially a lower tax burden come April. All right, so that's the fourth tip is reach out to your financial advisor. We're here, we're plugged in, we're working in the office. We are meeting with clients still, granted on a virtual basis to keep everybody safe and healthy, but it's easy. We can set up a Zoom call or a phone call and talk about your financial plan and see if we need to do any tax planning, out there. Okay, so for a quick recap, number one thing to do is check your tax deferred accounts. If you got a 401k, if you got a health savings account, if you got a donor advised fund, let's make sure that you're adequately funding those and taking full advantage of the potential tax benefits of those accounts. 2, if you have a taxable account with investments in it, a trust, a joint account, something that generates a 1099, take a look at your realized and unrealized gains and losses and have a conversation with your advisor. And maybe we'll bring in your CPA and do some planning regarding that. Maybe we want to take advantage of some losses or some gains based on your tax situation. Number 3, for all of our clients out there in their 70s, and if you're donating to charities and you have an IRA, I highly encourage you to look at this QCD or qualified charitable donation to potentially lower your required minimum distributions for 2021. Very neat strategy out there. If you're already giving to charity, why not lower your taxes? And again, the fourth tip is just reach out to your financial advisor. Certainly my team at Falcon Wealth Advisors, we're here, we're plugged in. If you work with your CPA and you want us to have a conversation with them on your behalf, we certainly can do that as well. Okay, good. So hopefully you got some value from these tips. Thank you so much for tuning in. Again, I'm out there in all the various social media platforms. So not all of them. I'm not on TikTok, but I'm on Instagram, Facebook, Twitter, and LinkedIn. Please feel free to connect with me. I always love growing my network out there. If you're watching this on YouTube, thank you so much for tuning in. Please feel free to hit that subscribe button so that you don't miss another episode of Upticks. If you're listening to this on your favorite podcast platform, thank you so much. Please make sure that you subscribe to that channel as well. As far as fun topics, not a lot going on with us. We did buy Rachel a new car that I'll flash a picture up on here. That was an interesting process. Interest rates have dropped. We had leased her car prior. So we decided to buy her an SUV. So that's something that was safe, good in the weather in Kansas City so they could get around in the snow, and something hopefully that she'll be able to enjoy and drive for many years. I am a car guy, but I'm not a big fan of buying cars a lot every year. Certainly if that's something that you enjoy doing, I'm not suggesting not to do that. But if you buy a nice car, typically, hopefully it'll last longer and you can get some mileage out of it. But I'm real excited for it. I think it might be the first time she's gotten a new car, brand new. I mean, literally, I think the thing had like 15 miles on it. We ordered it back in July and it finally got here in November, which is crazy, but good things come to those who wait. So that's what's new in the Falcon household. Again, like I said, I hope all of you out there are staying safe and healthy. And thank you so much for tuning in and hope you have a great week.